Hey, Pat, can
Hey,
you hear me?
Keith. I
Oh, I
can.
can't hear you. One sec. Can you say something?
I can say something. Are you ready to go? See, that's why we were supposed to be let in early. Hey, Rob.
Morning.
So we're just
Better.
Keith. There, you hear us?
I can hear you. Yeah, I can hear you. Whew, that was a that was a moment of oh crap. Oh, should I take my tie off? I just did a market.
No, you look good because I'm casual. You'll balance me out.
Okay, you're fine. No, I just did a market open, and it's like I'm already wearing it. I'll rock it for now.
No, it looks good.
Have Julie in a minute. Send a note to everybody. Hang on. Oh, he didn't have the link. That's why. Okay, hang on. In the link.
Hi, Pat. I do apologize. I was having some major difficulties. I'm on the call now, but let me know if there's any assistance needed for the panelists. I'll take over.
Yeah, Julian doesn't have the link. Can you send him the link?
Sure. Let me do that right now.
I just told everybody we'll start in a couple minutes.
Cool. I can't remember the exact order we were going through, but it's no big deal.
I've got it. Julian's the first. That's why I want to
Yeah.
answer.
So, Pat, what I'm doing is just getting the information through. As usual, we'll give a couple of minutes for the attendees to join. You could just introduce the panelists as to the backgrounds, and then by that time, we'll have Julian on board. Thank you so much. Good morning, everyone.
I can't do that. Oh, we'll forget that then. Thought I could do both. So we will get started. There is a slight delay for one of our panelists joining, but we don't want to waste your time. So we will get going, and Julian will join us when he can. Welcome and thank you for joining us for the 6th and final in our series of webinars on financial literacy. We're aiming to provide you with the tools that you'll need to navigate the financial services industry in Canada. My name is Pat Dunwoody, and I'm the Executive Director of the Canadian ETF Association, as well as someone who wants to support organizations like Computech and 369 Global that support individuals like you. Today, I'm thrilled to have with me two right now, but three shortly, individuals who are going to be able to answer any questions you may have and provide you with all the information you're going to need to know about ETFs. I'm going to let them provide a little bit more detailed background on themselves, But on today's panel, we have Keith Wu, the head of exchange traded funds at the Toronto Stock Exchange, Rob Butler, the director of BMO ETFs and National Managed Accounts Distribution at BMO Asset Management, the Bank of Montreal, and Julian Brott, the CEO of Hard Bacon. We're going to start with our own Q&A session with questions that we believe are important. And we'll provide you with the basic information, and then we'll open it up to your questions. However, if you have a question on anything that is being spoken about during the presentation, please just enter it into the Q&A section and we'll respond to it either during our sessions or at the end. So with that, I am going to start the questions, and unfortunately, I don't think Julianne is here yet. No, so going to be up for grabs because Julianne was supposed to have the first question. So Keith, why don't we start with you? Let's start off, actually no, Rob, because Keith has the second question. Maybe just give us a brief description of what an ETF is.
Sure. I apologize for my background to start here. I was put in my son's room, so that's you're gonna have to ignore all the kids' gear and memorabilia on the back of me here. But thanks everybody for joining today. In terms of an ETF, so we use the acronym, but it really does stand for Exchange Traded Fund. I think there's probably a few different ways to describe what it is that you're actually buying or selling when you're investing in the stock market, when you're using an ETF. And Keith, you can add to this, but the way I think of it is one of two ways: either a traditional mutual fund that is now available on the exchange. So, and that's where Keith is responsible. So you can effectively buy what used to look like a mutual fund, but be able to buy it or sell it on an exchange. So that's the first characteristic of it. The second way I look at it is similar to investing in a security, the way you would on an exchange. Often an ETF is a basket of securities that are tracking particular names that you're familiar with, such as Tesla, Amazon, Netflix, all these, well-known brand names. And an ETF allows you to buy a basket of securities on the stock market using an exchange traded fund. So those are kind of and for that reason, I actually think it's similar to both a mutual fund and a traditional security, but it kind of fits in the middle. And then I feel like Dinesh has an answer already planned for this, but that's how I would think about it.
Oh, Pat, you're on.
Yes, I know. I was shuffling papers, so I went on mute. Julian, so do you have anything to add to that? I mean, we've talked at a very high level what it is, but maybe can you expand, Julian, and then we can go to Keith on how they're similar to stocks and maybe how they're similar to mutual funds?
Yeah, I mean, sorry for joining late. I had just had a little technical difficulty. So yeah, I mean, ETF are just a basket of securities, like it was said before. Usually it's really interesting because of the lower fee. So it allows, retail investor to be highly diversified and really limits the fees they're going to pay. But basically it's a vehicle. So everything, like in general, there are lower fees, but there are that are high fees. Usually it's highly diversified. There are ETFs that are really exposed to a specific risk. But yeah, I think it's a great vehicle for retail investor in general.
Maybe I can add a little something, a little color to that one too, is that, like for ETFs, the world's first ETF was actually listed here in Canada. So we're actually, we're the proud, we can actually hold that on the mantle and say that, we were we launched the world's first ETF. And the thing is even just kind of like a history lesson too, is the fact that, yeah, the ETFs have been around for over 25 years, but I think the thing is that, and mutual funds are probably something that people are probably more familiar with or more comfortable with. I think even the fact is that if the design of ETFs had existed before mutual funds, most people would actually argue is that mutual funds wouldn't exist, that ETFs were actually the more ideal product, the more functional investment vehicle than even mutual funds. So, but hey, it's the way the world turned, right? It's the mutual funds came first, and ETFs were later. But that's kind of just a bit of a history lesson, but it was certainly something interesting.
So
Can I add on to
just
that, Pat?
absolutely, yes.
Yeah, not that it's a history lesson from my end, but I think in terms of who the original ETF was created for, it was originally for institutional clients, so bigger buyers and sellers of particular parts of the market. And what the objective was instead of an institutional or a sizable buyer looking to buy the S&P 500 and have to literally buy 500 different stocks to be able to replicate what that index looked like, the ETF was created to reflect what that index was, so that all of a sudden an institution could buy one line item in the form of an ETF to track that particular index. And in the last 25 years, what we found is it's really commoditized the way that retail investors and people like myself can get access to different parts of the market. So all the advantages, including fees and transparency that these gentlemen talked about, it's interesting to think that the original function was not designed for you and me, but that's in fact where a lot of the value is now being recognized. So I think that's an important distinction to make too. And when we talk about mutual funds versus an ETF, what it was created for has since expanded to a very broad audience.
What's even funny too is that from a product development, product management perspective, is that we always look at institutional first as the place in which money goes. So it's kind of like we always used to say when I was in a different shop, saying that it's where the smart money's going. Institutionally, that's where the smart money's going, and then retail is one that follows. Like you said, so it was built for institutional, but then it became a retail vehicle, right? So
I'm switching up the order. I apologize, but Rob mentioned the word index. So Keith, maybe I can ask you just to walk through what an index is and why it's important to the ETF industry.
Yeah, well, just to kind of expand on what, again, just kind of taking off of what Rob had already said, is that, again, it's like it is getting this basket of securities and, putting them all together. And, I guess it's intended to replicate, again, like a certain market. So, whether we're looking at the S&P, 500 or the S&P TSX 60 or whatever the case is that the intent is to, replicate this market and kind of provide a way in which companies can access a market and then even compare themselves, like use these indices or indexes as a way to benchmark how the performance of their product is doing versus versus these benchmarks. And I think so. One is to kind of look at it from the perspective of that, hey, it's it's kind of like one of the core indexes, but then also looking at what we call maybe like satellite indexes as well, kind of gaining access to other markets, being sectors or whatever the case is. So I'll give the audience an example of what we have done. Like, so obviously, we're known for like the S&P TSX 60, and that index is replicated in a number of different products. But we've also taken the opportunity to build like a battery metals index, right? And this focuses in on companies and other participants within the generation and the in construction of batteries and recycling of batteries and so on, and has created an index. And ideally is at one point, if a company wants to make an ETF out of it, they can do that. And that would be like one of those satellites that we would bolt on to a portfolio to gain access to something like that.
So how many indexes exist that could be used for ETFs?
How many? Oh my gosh. I never even thought to put a number to it, because the thing is that the indexes are we as the TSX, we have a partner in the S&P Dow Jones indices, in which we generate, I can't even think, just dozens and dozens of different indices with them. But this is, in addition to, like, I know like BMO as an example uses MSCI as an example, and others have Solactive, and so many more. Like that's just tip of the iceberg. So
it really is any industry, any sector, any geography.
Yeah,
anything
and I think it
that
really
could
comes
be of
down.
investment.
Yeah, exactly. And I think it comes down to how you know, a product manufacturer like BMO might feel like saying, you know what, we see an opportunity, you know, to provide exposure to this particular sector or this particular whatever market for our clients, right? So, and that's where I guess the Toronto Stock Exchange works with them to do that.
Okay, great. So, Julian, I mean, what we just heard from Keith in terms of, you know, ETFs monitoring and following different indexes, are all ETFs passive?
No, they're not. I mean, most of them are, and I think that's what, you know, the market is used to, like index ETF with really low fees. But they are actively managed, you know, ETF the same way that, you know, there are actively managed mutual funds. Usually those products tend to not have so much market capitalization and have much lower fees. So they look more like mutual funds, and usually mutual funds work because they're distributed by advisors. ETF are less. I mean, it's starting now, and that's a good thing that advisors start to sell ETF. But it's easier with salespeople to sell a high fee product. So I don't think they have much traction, but we never know. Maybe, you know, the ETF become the dominant form, and most, you know, mutual fund become ETF. At some point, we could see that. But there are some product, but they're not very popular or very big. Most ETFs tend to be index product. And like, you know, Keith said, like what is interesting with an index product is that usually the index, you know, to have a ETF that is based on an index, you need to have an index provider, and there's a lot of transparency. You know exactly what's the method to calculate why, you know, a company would be removed or added. So it's really like in a world where, you know, finance is a little bit scary and complicated. And I mean, we see what is going on right now in the market, especially in crypto, where there's no regulation and you don't know, you know, what's going on, what you're buying. ETF is very regulated and very transparent. So that's I think it's a feature of the product as well. And but yeah, they're not all index based.
Right. So Rob, what are the benefits then of using ETFs? We've heard a few in some of the answers, but if I wanted to put an ETF or ETFs in my investment portfolio, why would I do that?
Yeah, so most of my time is spent with the advisor base. So looking at different dealers and bank-owned dealers where traditionally a portfolio manager will use an ETF to either be a component of their overall portfolio. But I do have advisors that embraced ETFs in the last decade where their entire business is ETF driven, where they have, let's call it an asset allocation model with 5, 6, 7, 8 different ETFs, where they're able to track different parts of the world, take advantage of different currency pairings and risk profiles based on the client's particular needs and time horizons. So the advantages of an ETF, transparency keeps coming up in our conversation here. I think that's important, where you can go on to most providers' websites and in real time see where that particular asset is trading or being valued at. So I think that's important, where clients, just based on social media and paying attention to the news, that people like to know what's going on in their investment portfolios at any given time. And I think definitely ETFs have allowed you to be able to do that. I think being able to see what the security selection is underneath the hood is very important. And that's something else that ETFs are allowing clients to be able to do. So rather than buying something and looking at it again in 2 months from now and saying, I don't even remember what it is that I bought. I know it sounded good and had the right name, but I don't know what I own. ETFs really help simplify or mitigate that risk, where again, you can go onto a provider's website, you can likely go onto a trading platform or speak to your advisor, and they'll know exactly what it is that you're tracking as a reference. The other thing that's interesting is when clients are buying or selling an ETF, it happens throughout the day. So typically with a mutual fund, an advisor or an individual for that matter may allocate money to a mutual fund, and they would get end of day pricing is what it's called, and then they would get filled on that position. Whereas an ETF, you can get filled in a matter of a couple of seconds, depending on where the advisor or the individual is going to be putting a price in, or what they're prepared to pay for a particular ETF. So that's interesting. Another advantage, ETFs, I think, have actually added liquidity to a lot of different asset classes. So that could be the likes of fixed income. It could be potentially global exposure where, let's assume you were trying to invest in the global market and that market's closed, but you're awake and you're looking to trade that particular part of the world. You have the ability to trade an ETF during traditional market hours here in North America, even though that foreign market might be closed. So depending on what your objectives are, that's kind of interesting, where a client can act upon their particular intuition and what it is they want to do with their advisor, and potentially buy or sell at a particular asset class. And you can do that again during North American market hours, which is interesting. And you can't necessarily do that easily with other tools, or even the security itself, for that matter, if that market's not open in the foreign jurisdiction. The currency piece is important too. A lot of what ETF providers do, they offer hedged and unhedged solutions. So that's something you'll want to be aware of, where as Canadians, we tend to look at the US Canadian currency, whether we have snowbirds or maybe have relatives in the US, and we just tend to be more focused on what the currency pair looks like. Using an ETF with a hedged format might allow you to de-risk that currency exposure. So you're not having to become subject to different moves in the Canadian and US dollar on a day-to-day basis. So I think for some of those reasons, I mean, that's why we do see clients embracing them, and the growth, and we talked about it a little bit, individuals for sure, institutions for sure, even the advisor base though, based on the last couple of years being stuck at home, being able to revisit some of what the tools that these advisors were using, it gave them an opportunity to say, I wonder what else is out there. I've been using this for 10 years, a particular investment maybe, but I wonder what the equivalent might be in an ETF based on the advantages that we just highlighted. And I'd like to entertain that as a potential purchase idea. So we have seen a lot of that in the last number of years, hence the growth of the ETF business in Canada and in America for that matter. I think you're on mute.
I'm not going to do that anymore. Keith, we've heard about the advantages and that they should be as part of your portfolio. So how would I go about and buy an ETF or sell an ETF?
Yeah, well, you know, I think Julian and Rob have covered part of it, but I think let me go into a little bit more detail. So obviously, I think, you know, there's obviously the direct investing, and then there's investment advisor based, right? So, you know, direct investing, you know, like you've got tools and services, apps too, for that matter. You know, they include things like, Wealthsimple and BMO Investor Line, and you've got Qtrade, and you name them all. They've all have ways in which individuals, particularly on this call, you know, can access ETFs and stocks and so on, right? Now, but the thing is that it also, like, again, it's an effective way for, you know, a person, an individual, to kind of enter and exit the market, and, you know, and so on. But the thing is that what you're missing is probably the most important part of this, kind of the other way in which you can purchase and sell ETFs, is using an investment advisor. Because the thing is that, yeah, he or she is going to give you the ability to, you know, buy and sell out of, you know, certain positions of ETFs or stocks or whatever the case is. But the thing is that with that also comes you know, their expertise and their ability to kind of you know, talk with you about the particular investment that you're going into. You know, whether, you know, you're, you know, looking at, you know, holistically your portfolio, and, you know, helping you decide, you know, do you really need to allocate, you know, I you know, jokingly say, like, you know, that battery metals index that I was talking about, do you really need 60% of your portfolio in that? No, you don't, right? You need to talk to your investment advisor to help, for him or her to help you, you know, decide, you know, what makes sense for you, what is suitable for you, right? Based on, you know, the type of investor you are, maybe the, you know, the position you're in. Are you, you know, are you 20 years old? Are you, you know, 65 years old and looking at, you know, retiring? You know, are you looking at, you know, estate? You're looking at capital preservation. These are all big questions that an investment advisor will help investors, you know, make. And I think now we'll go into kind of like one other aspect of it is finding an investment advisor. There's not one size fits all. There is like two different call main types of advisors: the MFDA advisor, Mutual Fund Dealer Association advisors, and the IROC advisors. Now, Mutual Fund Dealer Association or MFDA advisors don't necessarily have access to ETFs, right? Some do, but not many of them do yet, right? IROC advisors do, right? And these are the individuals that are actually going to be able to, provide you with, the insights into ETFs and so on. And I think it's really important is that, at the end of, let's say, this conversation, is that you feel that ETFs would really fit into your portfolio, are, something that you want access to in your portfolio as you are looking for maybe your current advisor, or you're interviewing for new advisors. You have to really find out whether or not this particular advisor that you're using or considering can give you the access that you're looking for, being in ETFs. So, I think, again, these are questions that you should be asking, as you're talking to individuals.
Great, thank you. Rob, back to you. Some people have heard that there may have been problems, that there may be problems if they need to sell their ETF when they want to sell it. Is that true? Is that an issue?
I mean, it's one of the most important parts of BMO's ETF business, and any of the larger players for that matter. So we talked about the term institutional clients a little bit earlier. The reality is, if that was a real concern, institutions would never buy an ETF. I mean, the biggest part of their business being fee management, so making sure they're getting access to the most appropriately priced exposure using potentially an ETF, but also being able to trade in and out of it for liquidity reasons. So we actually have a 1-800 number, and anytime we have a more sizable client that's looking to either come into the market or actually sell a position, we often handhold that experience for them. So it's really important, and that's how we effectively are able to win business for larger clients that have big positions that they need to get out of in a lot of cases. So one of the best tests that we've seen probably back in April, March and April of 2020, when the markets were coming under a lot of pressure. Fixed income is a great example, a less liquid product to be able to trade, just a traditional bond, which often trade what's called over the counter. An ETF, and I talked about this a little bit earlier, has actually, in our opinion, added liquidity to some asset classes. And at that time, our clients, if they needed to unwind a position or sell a position, they would call into our actual 1-800 line. We would go out to what's called different market makers, who could then create a market or price a market to be able to allow that client to sell the position. And that's the value add for most of ETF providers. Now, when I buy it, no, I mean, I'm not buying anything with enough size that's really something that I get too concerned about, but larger clients, that's super important to them. So and again, I suggested I cover advisors. We'll often have advisors that will call just to get an update on where we see pricing on a particular ETF in real time, so we can help guide them and give them an indication of what's the realistic price and maybe where they want to be putting in a limit order. So that is something I should talk about, and Keith could probably talk about it too. Always the case, we would want our clients and our advisor base to use what's called a limit order and not a market order. And for those that do some of their own trading on their own, that's how we mitigate risk in terms of the price you're comfortable either paying or selling that ETF at. That should come with a 100% disclaimer. I always encourage my clients to use a limit. Not encourage, I require them to use a limit order at all times. And if they do see an anomaly or some discrepancy in terms of what they think an ETF should be trading at versus what they see on their screen, definitely do some due diligence and feel free to reach out to, if in the case of BMO anyways, you're welcome to reach out to me and I can help guide you through that process. So my long-winded answer, but I guess the takeaway though is that's one of the most important parts of our business, where and we call that trade execution. If that did not exist and we weren't focused on it, nobody would do business with us. So it's incredibly important to the success of all ETF providers, Canada or the US.
Just something I'd like to add, like on a retail perspective, because Rob, you mentioned like problem with liquidity. If a retail investor would invest in a really small ETF that would have a market cap in the millions, that's a danger. And I would be wary of those really, really small ETF, and also that the fees tend to be higher because they need to charge fee on a much smaller market cap. But anything that has, you know, I don't know, like market cap in the billions, you know, for a retail investor, he puts, you know, a few $1,000s in it. That usually there's, you know, just can put a market order and it's going to be sold within a second. Like if you're thinking about the TS660 of BMO or something like that, it's completely liquid. And yeah, like professionals will use, you know, different technique to try to shave a, you know, a cent or half a cent on per share. But for a retail investor, usually it's quite straightforward. Just avoid, you know, the smaller ETF that nobody knows about.
So given what Julian just said, what can be done? What partners does the industry have? And I guess this is Rob or Keith, that to ensure that I can sell one of these small ETFs if I hold a handful of units. Is there an operation that would ensure that we could sell them?
Yeah, I mean, one thing I love about BMO is the stuff we do is kind of boring. I know that's a word that people might laugh at, but we don't get into too abstract or you know, unique product lines. So we don't really come up against a lot of pressure in that case. In terms of the more, you know, again, unique product lines that might be harder to trade. Keith, you might want to comment on that. I mean, if it's BMO, just call me. I'll make sure that we get the proper execution. As far as third party, Keith might have a better answer.
Well, you know what, I think that that kind of speaks to the whole question about liquidity and kind of, you know, why it's important. And, you know, I think maybe kind of stepping back, and I think we've used the term, or I think either Julian or Rob had mentioned the term of market makers. And, you know, we can spend a whole afternoon talking about what market makers are and who they are and what they do and so on. But I think, you know, just kind of the, you know, kind of the high level, you know, 50,000 feet, you know, kind of perspective is that, you know, these market makers are the people or the groups that are responsible for kind of the creation and redemption of ETF units. And really, you know, when we look at liquidity, is their responsibilities is to make sure that, you know, market makers have enough cash on hand to, you know, either, you know, handle a creation or a redemption of an ETF unit. So, you know, it kind of really, to kind of boil it down into a really, really simple term, or kind of way that I like to look at it is like, you know, you imagine going to a store, you bought something, you know, let's call it $100 pair of shoes or something like that. And you go to a store and you want to return it. And let's say the store only takes cash, right? And just to keep it really, really simple. And you know what, you want to return it and they only have $90 in cash, not the $100 that you paid. All of a sudden, they're not really liquid anymore. They can't give you back, they can't, you know, fill that transaction for you because they don't have enough cash on hand, right? And you know, what would have solved that is that they carry, let's say, $120 of cash in their till or their float, right? So the thing is that it's what the responsibility there is for the market makers to make sure is that, you know, there is enough cash on hand to, you know, to manage through the creation of ETF units or the redemption of ETF units, and to really help prevent any of these large swings in prices, and really try to keep everything as smooth as possible. So, you know, I think Julian, you brought up these, you know, the small ETF providers. Well, you know what? Yeah, you're right. You know, these small ETFs are going to have some challenges in terms of liquidity, and it really comes down to, you know, making sure that, you know, from a manufacturer's perspective, making sure that they're partnered up with the right, you know, market makers and the right people and the right companies to be able to, you know, to have this type of liquidity or be able to manage through these types of situations. So, oh, mute again.
Sorry, my dog came in that time, so it wasn't paper wrestling. Can we assume, though, can I make the blanket statement that if I hold an ETF, regardless of the size of it and regardless of how much I own, I can always sell it?
Yeah. Yes.
Yep. Pretty much. And also what I said is it's like a ETF, you can look at the volumes and it would be like the extremely like an American ETF that invests in private equity and have a market cap of like 30 million. This is not going to come in your radar, you know, unless you're, reading something very fringe. So and also, since there is an underlying assets, like usually it's always sellable because someone's going to see, okay, the asset under it is valued at more than what the ETF trade for. But like for regular people, if they invest in, iShares, BMO, or like the main ETF, and even the smaller provider, like I was really referring to like the fringe, weird, really small ETF that have a really like a market cap like in the few millions. That this could be dangerous, but otherwise it's pretty safe.
Well,
Probably
even
ties
if
back to that original. Oh,
Oops.
sorry, guys.
go ahead. Yeah.
Yeah, just
Rob?
back to the original question in terms of know what you're buying. So you talk about some of the more fringe or niche types of exposures. Yeah, I think you just have to be realistic in terms of what it is that you're buying. If you're participating in the S&P 500, some of the ARC ETFs, like you do not need to worry about that aspect of it. If you're buying something that I can't actually explain and I'm not even familiar with on its own, whether it's an ETF or you're buying it on its own, there may be liquidity considerations there. So that's how I'd be treating it. You want to know what you're buying, do your due diligence. You should feel very comfortable if it's an asset class that you understand and you're familiar with. There won't be any issues.
Yeah. I'd add 2 points to that, is that it goes back to the original comment about, I made earlier about having an investment advisor, right? Your investment advisor should be looking at the suitability of that particular, investment that, ETF. And again, if it's a fringe kind of a, ultra short, super kind of a type of ETF, then, what your investment advisor should be telling you is that, well, this is a high risk type product. This may have liquidity issues. This may, and so on and so forth. He or she should really be identifying those risks for you. And then you yourself as investors will have to kind of really decide, is that really what I want? Or is that, that's too rich for me. That's too risky for me, right? And the second thing is to kind of go back to kind of on the technical side of things, is that I think it's a semi-annual basis, we actually issue a report to each of our ETF providers about, kind of liquidity on their each of their ETF portfolios. So we just do, we just kind of give them a heads up and saying, hey, these things look good, within a certain range, right? And I can't disclose that, but we do say, hey, you know what, these particular funds are looking good, these ETFs are looking really good, but this one's getting a little, could use a little help there. Can you bring it up with your team, right? And that gets handled. So we have a very open communication with the ETFs that are listed on our exchange to make sure that our providers are providing the best experience for the investors and the advisors selling the products.
Great. I'm waiting for no other comments. Okay, that's good. So Julian, based on everything we've heard and the comments going back and forth, is there an easy answer to what does better, I guess, in terms of returns, mutual funds or ETFs?
Yeah, I mean, it depends, like there would be many ways to answer the question, but in general, for a retail investor, probably ETF return better. I'm not saying it's the average return of all ETF because it doesn't make much sense. ETF are not trying to beat the index. So usually a mutual fund have, a portfolio manager and analyst, and they're studying the stock market, and they're trying to beat the benchmark index, which usually in North America is going to be the S&P 500. And the idea is that most people investing in ETF are indexers, and they just want to get the same return than the stock market. So usually they're going to invest in, either TSX 60, S&P 500 ETF, and then they're going to balance it with maybe some bonds ETF. But basically, they're not trying to beat the index. They pay much lower fees. And because of those fees, most mutual funds after fees are not actually beating the benchmark. And so I think it's 80% of mutual funds are actually not beating the S&P 500. So in general, for a retail investor, the answer is, and I'm not saying doing any strategy with ETF, you could lose a lot of money, it could be risky, but investing in the index and, copying a strategy like, and today you can obviously an advisor, you know, is properly trained to do that. But now it's getting easy. Like you could, you know, see what a robo advisor have in the portfolio, and obviously they have different, you know, they have a conservative portfolio and aggressive ones, and so on. But or even I think there's a blog called Canadian Couch Potato, which you know, it's Dan Bertignoli, or I don't know if I missed his last name correctly, but he just released like his model portfolio, and it's really simple. I think it has 3 or 4 ETF in it, and it's really easy to buy and hold on to. So I think for retail investor, in terms of pure, you know, return on investment, either going with an advisor that can, you know, do an ETF strategy, or doing it alone. The problem with this comparison is that I'm comparing apple and oranges, because usually the reason people in the first place invest in mutual funds is they want to add the advice part, and usually the fees of the mutual fund encompass part of the money that goes to an advisor, and an advisor, and that's proven too. So the financial return might be better if you look squarely at, you know, do I invest in an equity mutual fund versus, you know, a S&P 500 or TSX 60 ETF? ETF wins. But in terms of self-directed investor actually get less return than people that are working with advisors. And the reason is that investors tend to, you know, when, you know, market go down and, you know, valuation are actually lower, that's when they sell. And you know, they basically do the inverse, and this is because of obviously, you know, the different level of financial literacy, and also just basic emotion management. I know a lot of people that are much smarter than me about investment and made horrible mistakes, and actually now just work with advisors and you know, don't touch their own money. So it takes, because it's easy, especially in the bull markets where everything is going up, it's easy to think you're really smart and to invest yourself, and you know, whatever you do, you know, unless you do something really stupid, you should get a positive return. But I think there is value to advice. Obviously, I think the industry is moving toward more you know, fee-based service, and I see even MFD firm that, you know, start to recommend ETF to their client, and they charge their fees not based on the ETF fee but just directly to the consumer. So ETF wins, but I don't think we should discount the value of an advisor.
Can I add something to that? Is that I think you know, Julian, you talk about you know, investing in ETFs, and you're looking at, you know, kind of, you know, following using index ETFs, but yeah, you're right. So you want them, you know, those that are just buying indexes are just kind of, you know, getting whatever the index is providing. But I think that's the part where I would say is that I think there are certainly investors who are looking to beat the indexes as well. So the actively managed ETFs too. So, you know, I think there are certainly, you know, well, you know, there's a very large percentage of ETFs out there that are actively managed, both equity and fixed income. But I think even more so is that, you know, there are, you know, even additional products out there that provide, you know, more upside potential and downside protection, you know, like particularly with like covered calls. This is something that Rob can talk about, you know, all day about, you know, from a covered call perspective, is that there's plenty of products out there that provide the upside potential and downside protection that just following an index, a straight up index product won't provide. And I think so I think, again, this is where the value of advice comes in. But you know, I think there are more people that are looking for ways in which to, you know, generate more wealth and create more returns and so on, or lose less in the downside.
Yeah, I
Great.
think the
Thank you.
emotional piece that Julian talked about, that's one of the most important elements of our client base that we talk to. So even though our advisors that I would typically work with, they're managing multiple families' assets, they too are looking for insight around the market at all times. They're doing their due diligence so that you're not necessarily having to do that. You can share ideas with your advisor, but let them do the homework for you to make sure that it's appropriate and it's a nice fit for your longer term objectives. I think the fee piece, it's kind of fun because being at BMO GAM, we do mutual funds, we have ETFs, we have what's called an SMA product. I'm kind of agnostic in terms of what I'm going to talk to, as long as the client's comfortable with it and it's the right tool for them to be using. I'm very happy to support it. the one thing that we talk about, active management versus passive, I do have clients that love a particular portfolio manager that maybe manages their fixed income for them or their global equities for them. And if they feel as though the fee justifies the performance numbers, I don't think there's anything wrong with that. I think that's, if they identify with it and it gives them peace of mind, whether it's in an ETF wrapper or a mutual fund, as long as you're comfortable with what you're getting for the price or the fee that you're being charged, I don't think there's anything wrong with that. I don't think cheap always wins. So I think I wouldn't want to give the misconception that as long as it's less expensive, it's better. I don't think that's the case. I think you need to make sure that what you're buying is going to deliver on what your objective is based on your comfort in whatever that fee looks like. And that's very subjective. So those are two or three things. The other thing I'll kind of, for my section anyways, with BMO, we a lot of our ETFs are available in a mutual fund wrapper for the same price. So that's why I say, the term ETF, mutual fund, SMA, I'm not super tied to that. I'd look at them as a different vehicle to be able to get access to a particular part of the market. And again, you want your advisor and yourselves to do the due diligence to make sure it's the right tool to achieve your ultimate goal. As far as what it's called, as far as how you're buying it, you just need to feel comfortable with what it is. And they all add different, benefits in terms of how you're going to buy or sell it. But I think the BMO's recognize that a lot of the times, if you can make it, that is the investment identical across different types of wrappers for the same price and a similar experience for the end client, that's really the ultimate goal. We want the client to recognize what that goal is and be able to deliver on that or in line with what the expectations are.
Yeah, for sure. I mean, I'm not, some people say, like the successful fund manager are just lucky and, the law of elimination, some will be lucky and then they will attract more fun and so on. But even if you believe that they are, but the stat is that, 8 out of 10, actively managed portfolio in terms of mutual funds are underperforming the index. And this, it's so hard to find, like we know now, if you look at history, like, investing in, the Magellan fund that was managed by Peter Lynch was probably a good idea, in the 70s. And the return is just spectacular. So I don't think Peter Lynch was lucky. The problem is that if you look at the different fund manager, even if you look at a track record, the past performance is not indicative of future performance. So it's really hard to pick the right fund manager. And I think it's also in terms of personal, preference and also the advisor's expertise and so on. Like, I think there are people that are really good at picking people or picking funds. And in that case, that's their zone of comfort. But statistically, probably index investing for a retail investor is a better idea. But like you said, it's not just like index. It's not because you index that you cannot use different strategy. Like covered call ETF is based, on an index. It's just that you get, a little performance on top. So there are ways to, and you can have, you can index in part of a portfolio. You can say, okay, I'm going to index emerging markets, but I'm going to, pick stock in equities. So I think it's, ETF is a tool and indexing is something really smart, but it doesn't have to be one or the other. And I feel in the industry, there are people that are kind of, it's a religion. It's like, if you don't index, you're crazy. And other people are like, indexing is the stupidest thing. Why would you buy bad companies that end up in the index? So I'm not, I think it's just depend on, whatever preference and comfort level you have.
Yep. Thank you so much. Okay, Rob, new question. And we've skirted around this topic a lot, but by generality and specifics, are ETFs risky?
Oh, well, I think that ties back to doing due diligence or employing your advisor to do that for you. I think we talked about liquidity, we talked about transparency, we talked about an asset class that we're comfortable with. I mean, I'll just speak to myself. Like, what do? I really try to avoid product lines or asset classes that I can't explain. Regardless, I think the last couple of years has been a great example of this, where you're hearing a lot of interesting meme ideas coming up in social media. Bitcoin, no question, it's been incredibly topical. My default mode is I don't chase what we see in the media. I have to feel comfortable and I have to understand what it is that I'm buying. That's just my general rule, though. And then I guess the other part, whether you're a fundamental investor or a technical investor, that might also influence what you're comfortable with. I'm, again, pretty boring, so I'm more of a fundamental type of investor, and I buy products or investment vehicles that I'm comfortable with, and I can sleep at night doing it. And I can explain in a month from now why it is that I bought it. I think that's another one. I think it's a great measuring stick for whether or not you should invest in something you're kind of unsure of. If I can look at you in 2 months from now and I ask you, why did you buy that? You need to be able to explain to me why it is that you did it to feel comfortable. And I kind of use that rule as a soft target. So sure, there's going to be risky ETFs out there. There's going to be risky mutual funds. There'll be risky any asset class that you're not comfortable with or familiar with. I just tend to avoid them as gimmicky a lot of the time. So I don't know, maybe that's not a direct answer, but of course there's going to be more risky assets out there than I'm comfortable buying. I just typically avoid them by doing due diligence or employing your advisor to do that homework for you.
So it's not the asset, it's not the ETF that's risky, it's what it invests in that could potentially add risk.
Oh, I think it's good that you emphasize that. So and that's why I say whether it's a mutual fund, an ETF, a security itself, it's the underlying asset that you're getting exposure to. That's the part that can add risk to the profile, not because it has an ETF wrapper around it. That wouldn't be my concern.
Great. Keith, maybe walk us through a little bit of how ETFs are regulated in Canada. We spoke in the very first webinar, I gave an overview of the industry. So maybe you can sort of talk about how ETFs and maybe even advisors that you go to are regulated to give comfort to the investor.
Yeah, for sure. I think, when you talk about regulation and, regulation kind of almost assumes is like, oh, things are going to be, if you're very well regulated, it also means is that, you're going to be very tight and buttoned down and you can't do anything. And so I'd actually kind of challenge that definition, say that, what, Canadian ETFs are very well regulated, but it also doesn't mean is that it's regulated in a way that it prevents innovation. So let me explain. So just very quickly is that to get an ETF approved for sale or for or to be listed on the Toronto Stock Exchange as an example, in order for it to be listed, every ETF must have filed and been receipted or approved, that's probably a better word, is approved by the Ontario Securities Commission, or OSC. And not before and not until we've got that receipted or approved prospectus in hand will we actually list that particular ETF. It has to be done. That's the base minimum. Now, again, is that that means is that it's gone through all the rigors legally. It's reviewing objectives and what's going in the product and who it's available to, what the risk measurements are that kind of Rob talked about. Is it high, medium, low? And there's a lot more risks range within that risk out there. But where does this product fit in and who is it suitable for? Basically, arming the advisors and I guess the independent investors with all the information about the particular product. But again, is that in order for us to even put it up onto our exchange, it has to have a prospectus. But again, let me go back to one of my original points is that just because it's highly regulated or well regulated doesn't mean that it's preventing innovation. So I said earlier when we first started the conversation is that the very first ETF, was listed here in Canada, right, along with the very first fixed income ETF, right? And then Rob talked about cryptocurrencies. Well, you know what? Canada was also the place in which we launched the very first crypto ETF. So the Bitcoin ETFs and the Ether ETFs and many different variations in between, right? Canada is the pioneer of innovative product development and bringing ETFs to market. So again, highly regulated and very well regulated, but not to a point where it chokes out innovation. We actually, as Canadians, as Canada, really lead the market. We don't sell as much as maybe the Americans, do, but it's our population's different, right? But we do lead from an innovative perspective.
And I would just add, for those that are interested, the mutual fund rules are basically the same rules that ETFs follow. So they're the same. So we've got one question that's come in, so I will interrupt our questions. So what is your advice for people who are very fundamental and don't know a lot about ETFs? Should they start learning about them and invest? Also, if you want to know all aspects, where should they start doing their research and understanding the products?
Well, I'm going to be biased. I'm going to send you to BMO's educational website. I actually see it in the chat here, the webinar chat, bmoetfs.ca. And again, yes, I worked for BMO, but it's very well laid out and very basic in the way it starts to introduce some of the concepts that we've talked today. And it'll take you in whatever direction you want to. If you want to build upon some of what we chatted about around market makers, like there's a whole section on market makers to give you a proper definition, the function that they provide. That would also touch on buying and selling an ETF, and it would just go into more detail about some of the topics that we've covered here today. And that's literally 1/100th of what that website does. I mean, you can in real time compare an active mutual fund to an ETF in real time, any provider, not just ours. So there's some really fun tools to be able to play around with and do your own due diligence. And then I think the theme for today, though, is, I mean, I do encourage you to talk to a professional as it relates to a financial advisor that might be appropriate for your objective and the planning that you have in place. So you could do that. I mean, obviously, there's a number of different dealers, IROC dealers, being Dominion Securities, CIBC, Canaccord, Nesbitt, of course, and do your due diligence that way. You want to make sure, similar to choosing a doctor, you want to make sure it's somebody that you're comfortable with, that has your best interests in mind, and that you gel with culturally. So I think, that might go without saying, but I do encourage you to do that if you're newer to this part of the world and in the investment space.
So thanks, Rob, for the comment. I agree with everything you said, and the BMO ETF Center is pretty good. I think it revolves with, I think the other thing that I use for ETF is Morningstar, which has a lot of data, but the BMO ETF Center is good. I could mention also that there is some information, the Arbican app, but it's just on mobile, not on the web version. But one thing that the person who has the question mentioned that he is more interested in fundamentals. So I wanted to mention that most of the the valuation ratio that you look for stock for an equity ETF, you're going to find the same. So the PE ratio you can calculate the average PE ratio of an ETF, and it tells you how much you pay based on the profit. You could also look at the average price on sales and so on. And at the end of the day, it's just you're buying, especially if you're buying an index and ETF, you're buying probably more stock than you could buy if you did it on your own. But at the end of the day, if you are interested in fundamental, you can choose ETF that have good fundamentals, either looking at different indexes, and there's also ETF that are managed with an investment thesis. So there are like deep value ETF as well. So for sure, I think it's you could be all sorts of investor and invest in ETF, because ETF is just a format or a vehicle.
Maybe I'll add in one thing too, is that I also saw it in the chat too, is what we have is the TSX ETF Investor Center, and that actually is a center in which it actually has a combination of kind of ETF 101 type content. So stuff that that Rob, Julian, and I and Pat, we've all been talking about today. So all of that type of information is sitting there now. In addition, you're going to find things like articles and content that is actually supplied by the ETF provider. So BMO is obviously a very big contributor to the site, but along with the BlackRocks and the the Franklin Templetons and the even the smaller shops like Brompton and so on, they are contributors to the site. And if it isn't going to be a product push. It's going to be an educational. It's about talking about, maybe specific sectors or things that you might be interested in, and so on. And then finally, very similar to kind of, I guess, the tool that's on the BMO site, and that Julie mentioned, is that the ability to do a screener. So, we look at the over 1,000 ETFs that are listed with us to actually be able to search on, maybe a company, or maybe a particular theme or sector, or whatever the case is. And, the tool will help you find that. Again, it's not a replacement for the value of true advice. This is just a place in which you can sit back and do some research and connect to, if you're looking at a BMO ETF on our site, you can click on it and it'll pop you right to their site, because they're going to be able to give you the most up-to-date information, the clearest amount of information, and be able to connect you with, an advisor that will, help you determine whether or not that particular product is suitable. So I would certainly encourage anybody on this call to take a look at that link that was, I think, supplied in the chat. And, for all of the links that were supplied in the chat, is to open them all up and bookmark them all, right, into your websites, and use them. Right, that's what they're there for. They're intended to be unbiased. They're intended to be, focused on education, help you make good decisions. So.
And not to be left out, the ETF Association on their website also has information there from the members specifically, but we're launching our new website next Monday. So that's, and I should know the date, the 21st of November. And there will be more avenues to go there, and we will send you to educational pages. So it's, as Keith said, I would say most, if I want to say all, but I will leave it at most of the ETF issuers are aware that education is needed still. And so they always have really good education on their websites. And then obviously information on their products. So you could go to any, come to the CETFA site, get a list of the ETF issuers, and do your own research. I would say you want to know a bit about the, the product and what they invest in and how they operate before you invest in them, or before you have that conversation with an advisor. But the information is absolutely out there. So we've reached the end of the time. So I'm going to do a roundtable quickly, each of you, and just say, is there anything that hasn't really been raised in a question that you want to make sure the listeners hear? So Rob, we'll start with you and just say, is there anything that hasn't been said or that you'd want to stress before we close out?
Yeah, don't be overwhelmed by everything we've talked about. I know there's a lot of different considerations, and I think it's a fun educational experience. Just get out there, feel comfortable with what the acronym ETF stands for, and just start to learn a little bit about what might be accessible and what might be of value to the way you want to invest your money longer term. And it's just a really good vehicle and a compelling tool that we all have access to now. So take advantage of it.
Julian?
Oh yeah, so I think we talk about fees, but I just would like people to especially retail investors in the room that are not so familiar with MER. So MER is management expense ratio. I don't know if one of you guys mentioned the term, but this is how much fees, and usually it's going to be a percentage of that is going to be taken out annually to pay for the fees. So usually you don't see it in your brokerage account, but for sure it does impact performance because it's paid among the fund. Usually, like in Canada, like you can have ETF that are like 0.2, 0.3. Usually it turns around that. So if you pay that, that's pretty good. Then active, you can pay up to like a typical mutual fund is going to be 2-3%. So it's much less fees. But check for each ETF. Each ETF have a different fee structure. Usually you're going to find cheaper ETF in the US because they have higher market cap, so they can charge less in percentage. But just make sure, we talk about hedge, make sure you're not taking too much risk, because your investment is going to be in USD and you're making two bets. The bets on the growth of the securities, but also a bet that the American dollar is not going to go down compared to Canadian. So that would be my just the thing that I would like people to take away.
Okay, and Keith, what's yours?
Yeah, you know what, I think to really circle back on, again, and really driving the point home about the value of advice. I think, there are many people that are very, very smart who can certainly, do the investments, buy ETFs and stocks and so on, all on their own. But the thing is that, it is always a great idea to talk to somebody who, lives and breathes this stuff daily, and to help you make really good educated decisions. People feel is that they can read all this great stuff up on the net and become experts, and that's not necessarily the case. You would be amazed as to how much more information that ETF providers, BMO, RBC, TD alike provide to these advisors that really give them every possible tool for them to make and help you make these decisions on which ETFs to buy, which ones make sense for you and your family, and really set up goals for you too. And again, it is a very important part of this journey. And you know what? Like I said, there's over 1,000 ETFs for you to pick from. So you know what? There's plenty to go around. There's lots for people to pick from, right? It's about picking the right one. And you know what? Don't be afraid to use it. It's always good to ask for help. Right.
Great, thank you for that final roundtable. And thank you, Keith, Rob, and Julian. I think this was a really helpful sort of launching off part. And I think it was great that we ended with this, because everybody had a sense of learning the industry, and now we're hopefully setting them off in the right direction for starting to save for retirement or whatever they wanted to save for. So thank you all. Thank you all that are on the call for your support of the series. We're meeting in the near future to find out what we will do for next year and whether we continue it on or redo them. So stay tuned for that. But again, thank you, everybody, and we'll see you soon.
Thank you.
Great. Thanks again.
Bye.
Thank you. Bye.